Ever wondered how that magical thing called banking interest works? Well, it's not as complex as it may seem. Strap in as we delve into the world of banking interest. Banking interest can be seen as the cost of borrowing money or the reward for saving money. It's a way for banks to incentivize saving and manage borrowing. When you deposit money into a bank, you're essentially lending that bank money. In return, the bank pays you interest. On the flip side, when you borrow money from a bank, you pay the bank interest for the privilege of using their money. So, how is this interest calculated? Well, it's usually expressed as a percentage of the amount of money deposited or borrowed. This percentage is known as the interest rate. The frequency at which this interest is calculated and added to your account is also crucial. This could be monthly, quarterly, annually, or even daily in some cases. This is known as the interest compounding period. There are two main types of interest rates, namely simple and compound. Simple interest is calculated on the principal or original amount of a loan or deposit, but compound interest is where things get interesting. It's calculated on the initial principal and also on the accumulated interest of previous periods. Now let's talk about the types of banking interest. There are primarily two types: the interest you earn on your savings or deposits and the interest you pay on loans or credit cards. The interest earned on savings is usually lower than the interest paid on loans. This difference is how banks make a profit. Here's a fun fact. Did you know that the concept of interest dates back to ancient times? It was a way for lenders to be compensated for the risk they took by lending their money. Today, banks use interest rates not only as a tool for business, but also as a way to control the economy. Lower interest rates can encourage spending and investment, while higher rates can slow down the economy by making borrowing more expensive. So, to summarize, banking interest is a two-way street. It's the cost you pay for borrowing money and the reward you get for saving money. It's calculated based on an interest rate and a compounding period. And remember, the type of interest, simple or compound, can make a big difference. In the end, understanding banking interest can help you make informed financial decisions. Whether you're saving for a rainy day, planning a big purchase, or navigating the world of loans and credit, it's always good to know how your money is working for you. So, the next time you see that interest rate on your bank statement or loan agreement, you'll know exactly what it means. And that, folks, is the lowdown on banking interest. It may seem like a small detail, but it can have a big impact on your financial journey. So keep those interest rates in mind, and happy banking.